Today, an investor in India can execute a trade on their smartphone in a fraction of a second, guided by artificial intelligence and live data. But the roots of this massive financial engine started in 1850, under a single banyan tree in Bombay. There was no internet or live charts. A small group of traders gathered near the town hall, buying and selling shares through verbal agreements and handwritten notes. Trust was the primary currency, and deals were often finalized with a simple handshake. This informal gathering slowly grew, and by 1875 it officially became the Bombay Stock Exchange, the oldest stock exchange in Asia. For over a century, investors could track individual stocks, but there was no single indicator for the market as a whole. That changed in 1986 with the introduction of the Sensex, a sensitive index of 30 major companies designed to represent the overall health of the market. The Sensex gave the market a modern way to measure performance. However, the physical trading system underneath remained archaic, struggling to keep pace with the needs of a rapidly growing nation. In the early days, trading was a physical endurance test. Investors had to gather on loud, chaotic floors, where information traveled only as fast as a person could shout. Proof of ownership arrived in the form of physical share certificates. Every transaction generated a massive trail of paperwork that required manual filing and sorting. This analog process was riddled with vulnerabilities. Settlement took days or even weeks, and certificates were constantly at risk of being lost, getting completely damaged, or intentionally forged. As the economy expanded and more companies sought capital, the sheer volume of paper began to overwhelm the exchange's fragile physical infrastructure. By the late 1980s, the Indian market was a high-stakes financial system built on a low-security foundation.
It relied on a network of runners and paper slips that was increasingly prone to error and manipulation. The system reached its limit in 1991. Facing a severe economic crisis, India was forced to introduce major reforms, opening its economy to foreign investment and private expansion. This sudden influx of capital pushed the outdated paper trading system to its absolute capacity, exposing deep cracks in how trades were settled and verified. These cracks were exploited in 1992 by Harshad Mehta, whose security scam shook the nation's confidence. Mehta weaponized the inherent lag in physical paperwork, using the weeks-long settlement gaps and a total lack of transparency to move massive sums of money without immediate oversight. While the scam shattered trust, it also provided the necessary momentum for reform. The incident made the transition to modern, transparent electronic systems a matter of national survival. The direct response to the crisis was the launch of the National Stock Exchange, or NSE, in 1994. The NSE replaced the trading floor with a fully electronic system. For the first time, buy and sell orders were matched through computers, making trades faster, more transparent, and accessible to a much larger population. To eliminate the risks of physical paper, the demat account was introduced. Shares became digital data points, making transactions safer and immune to the forgeries that had plagued the previous era. New benchmarks like the Nifty 50 and Bank Nifty were established alongside these systems, providing a broader, more accurate picture of India's modernized banking and industrial sectors. These innovations replaced an elite physical floor with a transparent digital network. By removing the barriers of the old system, the market became a tool for wealth creation available to every citizen. Today, the digital shift is complete. Millions of Indians manage their portfolios from anywhere in the country, using nothing more than a laptop or a smartphone. This new infrastructure has been stress-tested by some of the most dramatic global market crashes in history. This chart tracks the 2000 dot-com crash, the 2008 financial crisis, and the 2020 COVID-19 crash. Each initially created fear. Yet after every dip, the modernized market recovered to reach levels dwarfing previous peaks, unimaginable to the traders of the 1800s. These recoveries demonstrated the resilience of the new digital infrastructure and the underlying strength of the broader Indian economy. A new generation of investors thrived in this era by identifying businesses with strong growth potential long before they became household names. Rakesh Jhunjhunwala became a leading figure of this era, building a fortune through disciplined, long-term investing and earning the title of India's Big Bull. Trading is now powered by advanced technology.
Algorithmic systems execute orders in fractions of a second, and artificial intelligence analyzes vast data to guide decisions. Billions of rupees now change hands every day, handled by a marketplace no longer vulnerable to the paper bottlenecks and errors of the past. The tools of the Indian stock market have evolved completely, but the fundamental truth remains the same. The market continues to reward knowledge, patience, and long-term thinking.